All right, I think we have things started. I see that the number of attendees is still increasing, so we'll give it just another minute and go ahead and get started. All right, looks like we have a lot of people on the line already, so let's go ahead and get started. So hello, welcome to today's webinar, Create Value, Save Your Clients Money, Obtain Rockstar Status with Direct Indexing. So love the title there. My name is Andrew Gradis. I'm the Director of Investment Consulting at Adhesion Wealth, and I'm joined today by Adhesion's President, Barrett Ayers. Welcome, Barrett.
Thanks, Andrew. Appreciate you hosting the session today.
Yeah, thank you. Glad to have you here. So to get started, direct indexing has been a frequent headline in the financial market over the past 2 years, certainly. But let's actually take a step backwards to get started. Adhesion has been a manager of direct indexes for over 12 years, so certainly an early adopter and provider of direct indexing. In this case where Adhesion got started, you were providing a specific solution for a client need. So tell us a little bit about that. What was the solution that you were providing for this client?
Yeah, a great question. I'd love to say that we were, prescient and kind of anticipating the trend that is now kind of upon us. But, frankly, we collaborated with the client. They had a problem, and we needed to solve it. So it was about 13 years ago now, and almost 13 years ago, and a new client of ours at the time, who is actually still a client today, by the way, asked us about trying to take a new client of theirs who had something like 150 low basis holdings and somehow migrate them into their strategy, yet at the same time trying to avoid a massive tax hit. So the portfolio itself was a disaster, and no way represented the risk profile of the investor at that time. So we spent a lot of time looking at ways to absorb the holdings from the portfolio into the allocation. And at the time, the new client of ours had been exploring a whole host of variety of kind of disposition methods. They were exploring collective investment trusts, some sort of elaborate gifting plan with options that they were writing against the long equities. Then they were looking at swap funds, and all of them were very expensive and complicated. The client didn't really understand them. So we kind of collaborated with the client. We came up with an idea to analyze the holdings in the portfolio and see if any of them looked like an index. We decided that with a few exceptions, the portfolio kind of by and large matched the return and characteristics of the S&P 500. So we asked the client for a gain budget that allowed us to do some trimming around the edges of the portfolio and generate some cash for a few purchases. And we're able to take 100 holdings and nearly identically match the risk and return profile of the index. We liquidated something like 30% of the portfolio to fund the firm's new strategy and leave everything else behind in what we then called our index sleeve. And so at the time, every month we would look into the portfolio for losses to shrink the index sleeve and opportunistically harvest to fund the firm's target strategy, basically moving from the index sleeve to the portfolio. Eventually, over the next couple of years, we institutionalized the process, and we now call it our tax transition service. And that portfolio that was in what we called at the time the index sleeve was a very early version, again, almost 13 years ago, of what we now call a direct index. So it was really, to the point, it was really born out of a need for clients to minimize taxes, but yet at the same time kind of customize the transition. So really the long and short, to answer your question, what is a direct index? It's very simply a basket of securities that are held by an individual investor that track the risk and return characteristics of a specified index. It's held inside a client account. The tax lots, the holdings belong to the client. It's not a pooled investment. It is entirely and thoroughly the roll up to the ownership of the investor. And therefore, there's a lot of really cool things we can do around flexibility and customization and personalization, taxes and low cost, things that we're going to explore a little bit in the rest of the session.
Sure. Yeah, we'll certainly be going through a lot of those benefits there. Since that time that we got started, we've seen incredible growth in direct indexing. Actually, expected growth of over 12% annually over the next 5 years. That's faster than ETFs and significantly higher than mutual funds, at least on a percentage basis. So why is it that direct index is growing faster than eclipsing ETFs and mutual funds at this point?
Well, I think honestly, I think the direct index story is rapidly growing because it's an easy story to tell, right? Advisors understand it. Clients can see right into their portfolio and they can see the holdings, and it all matches the story. And I think really, if you boil it down, first off, you get the flexibility of individual position ownership for the investor, which is a massive benefit, right, for any investor, because you can tax manage the portfolio to generate tax alpha, which means actively harvesting losses to generate a tangible and recurring benefit to the client, right? You can customize it, which means, as you're building that index for the client with these holdings, you can tilt it to match the individual preferences of the client. That means you can layer on like an income overlay for a client who's looking for some sort of a fixed income rate, a volatility dampening overlay for folks that are not interested in the oscillations of the market we find ourselves in today, and a whole series of ESG modules where maybe you tilt it to match the lifestyle and personal preferences of the client. It's optics, right? You can look right into it and see it. Unlike a mutual fund or an ETF, you don't really know what's inside of it. But here you know that it can match the preferences of your client. Like our client we described back in 2010, our very first direct indexing client, you can also absorb pre-existing holdings into a direct index. And because it's not a pooled vehicle, the tax impact doesn't get passed along to the end investor. So as advisors and clients alike, we all know, when a mutual fund is down and has a bad year from a performance perspective, and you're answering questions about why the mutual fund is down, yet at year end, your client is getting some sort of capital gains distribution, which is a taxable event. That doesn't happen with individual direct holdings. So there's a story there that's really easy to tell around direct holdings. And not to mention, the cost of a direct index is usually the same as an ETF. So from that perspective, it's a really good story. It matches the story of the advisor, low cost, tax efficient, personalized, customized, the ability for an advisor to kind of differentiate their own practice based on this really powerful tool.
Sure. And, and sticking with, comparing to ETFs and mutual funds, I know accessibility is a common topic among our RIA clients. Many feel that you need to be ultra high net worth to buy a full index, and so we certainly know that that's not the case. So tell us a little bit about the optimization approach and building an index for clients versus owning everything.
Well, I think, it's interesting, Andrew. I mean, and you and I hear this all the time, but, you're right. There's this myth out there that you have to be an ultra high net worth investor because, frankly, in the first generation of direct indexes, you kind of had to be, right? Because you can imagine if you want to hold the S&P 500 and the old school way of doing direct indexes, you had to have an account that was large enough to house 500 securities, right? And that direct index was usually just a portion of the overall allocation. Maybe it's a 30, 40, 50% allocation. So that's a very large client who has a 50% allocation to a portfolio that holds 500 securities. So that is ultra high net worth kind of land. So it did pick up this reputation of being something that's for the very elite, ultra high net worth client. Well, that brings us to kind of the two methods of constructing a direct index. And so what we just talked about is one method, which is called replication. That is, there's 500 securities in the S&P 500. The client owns all 500 securities in their portfolio. You get with that very low tracking error. It's going to do exactly what the index does. It will clone the behavior of the benchmark. But again, it's difficult to have an account large enough to hold 500 securities. So there's the downside. So about 15 years ago in Adhesion, I'm very proud to say we're on the forefront of this other technique, which is called optimization, where you use an algorithm using mean variant optimization capabilities to distill down the holdings to a smaller subset of the portfolio. So rather than having 500 securities, we, as an example, target 100 holdings. We do that for all of our direct index, the S&P, the Russells, Russell 1, Russell 3. And through proper allocation, we can get the tracking error and return variance down to a very, very minimal and predictable level. So the majority of the return profile from an index comes from a much, much smaller distilled subset of the holding. So as an example, if you look at our direct indexes over the past 10 years, let's say, our S&P 500 direct index has returned just 0.04% off of the index. For the Russell 3000, with only 100 holdings, it's 0.19% over the past 10 years. So very, very tight return variances. They look just like the index itself. So we're a very big fan of the optimization approach because it gives you plenty of securities to use, which means you can allocate to much, much smaller clients.
Absolutely. Yeah. And so, I know there's a number of ways that you can implement them. So if I'm an RIA, how do you actually execute, where do you get your mean variance optimizer and go through that process? So what are the ways to do that?
Sure. Well, so that's the next natural evolution, right? So we've now explained that, you don't have to be a $10 million, $20 million ultra high net worth client in order to get a direct index. We've now made it available to, the mass affluent and the high net worth client set. So now the question is, how do you then deploy it if you're an advisor? And there's fantastic growth potential of the direct index. You've already cited the forecasts and the growth statistics going forward, and they're growing rapidly if you look back historically. I think to your point, though, the largest challenge facing successfully adopting direct indexes is how an advisor chooses to implement that direct index. And there's a lot of solutions out there. And there's a lot of press around it, like you said earlier. There's a lot of noise. And I think advisors, we hear it all the time, an advisor in their haste to, I would say, rapidly adopt something that really is a tremendous benefit to their client, sometimes they make bad decisions. And I would just caution advisors that as you're out there thinking about the direct index landscape, to explore a host of methods before deciding what's best for your client and, most importantly, for your practice and the way you want to scale it. So here are the options. Here are your solution set, I would say. The first is, there's plenty of software packages out there. You can go buy an optimizer. You can go buy kind of a turnkey piece of software where you put in what it is you're looking for. You hit the go button and out pops your direct index. It's probably going to come out in a spreadsheet and you'll have a fantastic direct index. Maybe it's got 100 holdings, low tracking error, low return variance, and you feel pretty good about it. Then the question is, what do you do with it? Right? That's where the scale problem is most problematic for advisors. You've got a direct index and you want to apply it to 50 clients. You can, trade the accounts to the model using some rebalancer tool. It's probably the cheapest approach, but needless to say, it is not tremendously scalable. So that's one end of the scalability spectrum, I would say. On the other end, you've got asset managers who are fantastic at managing direct indexes. They've got a 10, 15 track record in building direct indexes. The challenge is they usually are quite a bit more expensive than you might have to pay for, say, software. They have pretty high minimums, and they can only do it inside of a single account, right? So you wire in $1 million to an account, they can manage that account for you. Again, expensive and pretty high minimums. So the last option, the one that, frankly, is an adhesion solution, is using what's called a UMA platform. And UMA platforms exist like Adhesion to help advisors construct multi-manager portfolios. So that is develop an allocation, drag and drop models and managers into that allocation, one of which could be a direct index, but you could also have active managers in there as well. You can blend that low-cost direct index with the active manager. You keep the net tax burden down while simultaneously keeping the blended fee down, right? So tax burden improvement up, fee goes down. UMA platforms normally develop a direct index for you if you wanted, and they can run it on your behalf at a price normally somewhere between, let's say, the software solution and the asset manager, and it's highly scalable. So you get the direct index that you want inside of this multi-manager portfolio, which is highly differentiated, and you can do it at a cost that's normally around the cost of, let's say, an ETF.
Sure. Yeah, and so obviously, at Adhesion, we are huge advocates of using direct indexing. It's best facilitated in a UMA environment. So, why is that? And is it really that big of a difference in a UMA?
Yeah, well, it's a great question. We hear it all the time, and there are a ton of reasons. The first is clearly, and I think probably one of the most impactful, is that cost to scalability equation we just discussed, right? Relatively low cost, exceedingly scalable solution because you're effectively outsourcing it to a UMA platform. So that's the first piece. The second piece is when you put a direct index inside of a single account and you have other managers around it, the tax impact is astounding, truly. By keeping that direct index in a single account with other managers and models, the first thing you do is you prevent wash sales, which happens all the time, right? So every manager, I think, across almost every asset class holds Apple as an example. So at any given time, somebody's buying Apple, someone's selling Apple, and they're creating wash sales. The problem is most advisors don't know it's happening because it's happening in two separate accounts. They both roll up to the same client. You've got an all cap core model and a large cap growth model, and they're both buying and selling Apple, creating wash sales all over the place. But when you put those models inside of a unified managed account with a platform like Adhesion, you can monitor the buys and the sells to ensure the wash sales are not taking place. It happens all the time, and Adhesion's job is to prevent it. So when you introduce a direct index to the solution where you've got, let's say, 100 holdings, you've just exponentially increased the likelihood of a wash sale, right? Because now you've got 100, or in some cases 500 holdings inside of your direct index, buying and selling all the time, creating wash sales all over the place. So it's really important to put those inside of a unified managed account where all of those models can be monitored to prevent wash sales. The second thing is for position swapping. We do this all the time. Again, Apple is all over the place, right? So rather than selling Apple for a taxable gain in the large cap sleeve, we can actually just swap it over to the all cap sleeve where maybe it's underweighted. So in doing that, you avoid a commission and you obviously avoid the tax penalty because no trades took place. All we're doing is swapping them across sleeves inside a managed account. And the third is cost, right? And that's an important one, obviously, especially in this age of fee compression and new forms of competition popping up all over the place. The average cost of an Adhesion direct index is about 15 basis points. So imagine a core satellite portfolio that you might construct with the help of you, Andrew, your team, and or advisors developing their own portfolio strategies. Imagine a portfolio where you've got a 50% core allocation at 15 basis points, right? So instantly the blended fee to the client is already well below market rates for product costs and obviously highly differentiated against other advisors. And then we layer in the value of tax alpha, which now we're talking about value to the client rather than a cost reduction to the client. So not only are we reducing costs, we're increasing the value through this thing called tax alpha. And tax alpha is the tangible benefit that we provide by doing active tax management in a portfolio. And we can analyze it, we can quantify it, and we can show it, right? So in fact, Adhesion did a study a couple of years back where we measured tax alpha through tax management with direct indexing enabled. It added nearly 100 basis points a year in tax alpha. So those are tangible benefits we're adding right back to the client that's providing value and differentiating value to the advisor. Those are things you can hold up and say, I know I'm charging X basis points for my advisory fee, but look what I'm doing over here. I'm lowering the product costs and I'm adding a tremendous amount of value through this direct index and tax harvesting. And finally, the fourth is efficiency, right? We talked about that before. It's a really important point, especially for advisors who are looking to grow and scale their practice. The UMA, it's known for many things, and it's a very powerful tool, but it also provides for a rules-based rebalancing methodology across models, right? So you set the drift, you set the bands, you set the tendencies on how the portfolio should be rebalanced, and it just automatically runs. All the tax rules are in the background, and it also has things like, one-click cash raise. So you go into the account, you click the cash raise button, it raises the cash in the most efficient and tax efficient method possible.
Sure, absolutely. And I know we spend a lot of time customizing direct indexes for our clients. Really, in practice, this is more about differentiation. It's about offering something unique. So really, tell us how advisors are differentiating themselves from the street by using direct indexes.
Well, I think everything we're talking about here today is all a story about differentiation. You know, uh, I think advisors need to understand the story because, I don't think the financial press is doing anybody a whole lot of favors by just, there's a lot of noise out there about what a direct index is. But for the advisor who really wants to understand direct indexes and kind of craft a strategy around how to use them, I think it makes a ton of sense. So the whole story is about differentiation. I mean, think about the advisor down the street, right? Who, most of our advisors had competed with for some time, who's selling a 125 basis point, mutual fund wrap solution, right? That is easily picked off with an offering like this. Not only is it unique, it's got a good story to it. Again, the tax benefits, the cost benefits, the personalization and customization benefits. So it's a fantastic story. But then what we did last year, we kind of took it to the next level. We said, maybe it's time that advisors can start to tailor and customize their own direct index with their own specification. We did that. We launched a product called Personal Indexes. So it says, okay, so tell me exactly how you want to tell your direct index story, and we'll build something for you. So that allows you to do things like layer on personalized lifestyle objectives, things like, do not buy, do not hold, must hold, ESG modules and constraints, things that really reflect the kind of the personalized lifestyle requirements of the advisor and or the client. We also went through with personal indexes and said, imagine an assembly line where you're kind of moving the knobs and dials and building your own direct index. Maybe you want something that's got kind of a tilt to it. Maybe it's a smaller, more compact and concentrated direct index, something with 75 holdings to it. Maybe you want something that has a volatility dampening objective on it. These markets obviously these days are oscillating and volatile, and advisors want to have a story with clients that are about taking the highs and lows off of the ranges of the potential returns of the index. So we can put a volatility dampening screen on it. Or maybe there's an income objective and there's a required rate of income that needs to be pulled out of the portfolio. The optimizer that we use, we can tilt it towards something that's a little more income friendly. And finally, the ability to absorb in and hold things like concentrated stock or restricted stock and things that need to find a home. We don't want to sell it, but we want to build a portfolio around it. So a direct index is also a really, really powerful tool for absorption purposes, so that, as you're bringing in these low basis holdings that you want to restrict, or maybe you just can't sell, we can build something around it and buffer it up and make it look like an index.
Sure, sure. So, as we get close to the end of our time, I want to make sure to provide the opportunity for our attendees. Looks like there's quite a number of them, to ask questions. So certainly feel free to add those in the chat, and we can get to those. And just to build on a topic that you just touched on a couple of times with the absorption idea, and that's using direct index for tax transition. And so we have a lot of RIAs that have maybe left one firm or changing the allocations. And I can think of a recent example. We had a client, and they were looking at over 800,000 in capital gains. We did a lot of back and forth working on it. And by using a direct index, and a couple of allocation shifts, we were able to bring the capital gains down to less than 100,000. Over 800 to less than 100. I think that's a bit of more of an extreme example, but it's really that client at least loved us that day, so we were looking great. So yeah, any comments on similar stories on using them for tax transition?
Well, first off, you and your team, Andrew, do a great job with, absorption and developing, capital gain mitigation strategies. It's really, really powerful. We can work in a consultative fashion with advisors. Advisors can kind of run it through our proposal system and see what it looks like. But, when you start talking about transition and absorption, the thing that comes to mind for me that's really, really powerful, many of our advisory clients are looking to either acquire new books of business. There's a lot of firms that we talk to that are over at the wirehouses right now, and a lot of the transitional work right now really is from advisors breaking away and going independent. And so the number one objection that advisors hear that we're aware of is, geez, as a client, I would love to go with my advisor, and I'm leaving, XYZ wirehouse, and I want to go independent, but yet at the same time, I'm not going to move over to your new independent firm, sell all my stuff, get a massive capital gains hit. I would love to come with you, but the reality is that I just can't pay these taxes just because you want to go independent. So we put together for that objection a really powerful kit to help advisors pull that business away and show, if you come over, here's what we would do for you. We would put, all these low basis holdings into a transition sleeve. We would build it up, make it look like an index. And over the course of 2, 3, or 4 years, we will slowly start to, whittle away at the tax basis and start to reduce those holdings by opportunistic, harvesting and looking for losses inside the sleeve, and start to move those things over. So suddenly the advisor is now armed with this fantastic blueprint, a roadmap on how to move clients away from the wires, let's say, to independence. And so it's really powerful for teams that are looking to go independent. It's also really powerful for teams that, for firms that are looking to bring on new teams, and certainly for new clients who are trying to leave those firms as well. So lots and lots of ways that the thing can be harnessed to help folks transition.
Sure. So we have just a couple minutes left. I know we have a couple questions on the line as well. So Kay, would you be able to share those questions with us?
Absolutely. It looks like we have a question from Connor. Can you go a bit more into depth into swapping between sleeves within the UMA?
Sure. Yeah. So it's a really powerful capability, right? So basically what happens is you can imagine one day, let's say you've got an allocation that's got 50% direct index and 50% large cap growth, right? And on the large cap growth side, it's time to go sell Apple, right? And so Apple may have a pretty sizable, let's say, gain on it. But yet over in the direct index, you've got a position that's got a loss in it. So the first thing it can potentially do is it can say, look, there's better holdings in this other sleeve. I know we're not trying to sell to this sleeve, but why don't I just go ahead and swap these over first? And so the first thing it does is it swaps the holdings. And now inside the large cap growth sleeve, I have an Apple holding that's at a loss. So then the system goes through and it actually sells that, generating a loss rather than having to sell the position over on the other side. Now, the system does that as a transfer, right? So it transfers the holding and it resets the synthetic basis when it moves it from sleeve to sleeve. So from a performance perspective, it doesn't look like you just got free shares at zero basis, right? It actually looks in the accounting system as if you sold it in one sleeve and bought it in the other. But in reality, at the custodian, no trades have happened. They just got swapped over and it looked like the basis got recalibrated as if it had a new home instead of a new sleeve for the very first time.
Yeah, and keeps all of your performance intact and for each of those sleeves as well.
Absolutely.
Okay, any other questions on the line?
Nope, no other questions right now.
Okay, well, that's pretty good timing. Yeah, that brings us to the end of our scheduled time. So if you have any questions for any of our attendees about direct indexing or other services that are provided by Adhesion, you'll see the contact information for either your relationship manager or the sales team on the screen. You also see my information there as well. So I certainly would like to thank our attendees for joining us today. Thank you, Barrett, for sharing your insights. And this concludes this afternoon's webinar. Thanks for attending.
Thank you.